Red, guess what? Today I've got Drew Breneman with me. He's actually in Austin, Texas right now, but originally, Drew, where are you from? You were telling me before.
Um, yeah, I'm from the Milwaukee area. Both my parents were teachers in Milwaukee. Then went to college at UW Madison. Lived in the Midwest my whole life until 2 months ago. So now I'm a Texan.
Now you're a Texan. Well, let's go back in time a little bit. And I had a lot of fun going in and doing a little bit of research on your background. And I saw that when you were 19 years old, you bought your first real estate investment. And I'd like to kind of start there. And today, when I went on your site, I mean, you've got $200 million under management right now. You've got these beautiful apartment buildings, multifamily buildings that they've got like a modern bent to them, which I love. And so I just want to understand how you started and what brought you to kind of like that multifamily space, and just kind of unpack that. Our listeners want to understand how to create passive income through real estate, and you're well on your way there. And so let's start at the beginning. 19, you decided you're going to buy a piece of property. How did that come about?
Well, it was a similar journey to listeners and members in your network where they, I started an internet business when I was in high school. I was selling items within these online video games, just flipping the items. So sometimes like a armor set or a ring would sell for $20 on eBay, sometimes for 10. So when it was selling for 10, I'd buy it and then I'd resell it for 20. Um, and I made quite a bit of money for a high schooler who, because I had no bills, so I was able to save it all. So over the course of 4 years, I made like around $80,000 to $100,000, and I saved all of it. So I was kind of in a similar spot, but to kind of the folks you help, where I was thinking, what should I do with this money? So I was lucky in that regard where I started reading the books people, normally read when they're like 40. I read Rich Dad Poor Dad, as a teenager, and Think and Grow Rich and Intelligent Investor and all those books. And, really sort of, and my parents, like I said, they're both teachers. They were um, big on saving and investing in mutual funds. That's how they funded their retirement. They obviously had, I guess they had pensions as well, so there was a lot of talk about mutual funds, but not any other. I didn't know any real estate investors or entrepreneurs or anything. So I kind of started out looking at stocks and mutual funds. And I did that for, a year. And in that year, the market, either it went down or at least the stuff I picked went down. And I'm like, this is like, I have no control. Um, it's just like an appreciation play for the most part. The dividends are nothing. There's such a small amount of money. And so I started looking at what else was out there. I remember when the light bulb really went off for me in real estate, I was reading a book called called Investing in Real Estate by Gary Eldred.
Mm.
And that book is not as much like the Rich Dad Poor Dad's a great book in terms of getting like your mindset right. But I don't remember, and I read it like 20 years ago now, but I don't remember. There's not like a lot of tactics in that. It's more just kind of getting your mind thinking like there's more than just being an employee out there. You could be a
Hmm.
full-time investor. You could have a small business where it's just you. You could have a large business. Like there's other things you can do. Um, and one point that I either read in Rich Dad Poor Dad that I think was really important was it's actually safer from an income standpoint to have either your own, say, small business or your own investments that are making money, like real estate that you own, you control, or you're getting passive income from, than a job. So, if anyone's ever been laid off or fired, they know what I'm talking about. Your income can turn to zero at your job overnight. And and so that, whereas if you have a portfolio of properties, let's say, really the only way that could get turned to zero is just with some never before in time happened to the market, where
Hmm.
so 'cause even in 2008, I mean, people still were paying rent. I mean, rents dropped, so did occupancies, but it wasn't like it just went to zero like it could if you got um, fired. So, and I really liked what was in that book in terms of just explaining how it worked, where it was very simple. And the Gary Eldred book, where you make money from cash flow, paying your loan down, and then the light bulb really went off for me when he was talking about appreciation. The example is you put 10% down on a duplex. Let's say it goes up 3% a year. That's a 30% per year return on your equity. And I thought, wow, that's really It's oversimplified, and normally you don't put down 10%, you put more down. But
Mhm.
let's say you put 20% down, that happens. I mean, that's still a 15% return, and so that would be so that was really a light bulb moment for me, where I thought, wow, the returns could be quite high in this, and then you also have cash flow, and you get the tax breaks and everything as well. It's not correlated with other investments, or has a low correlation with the stocks and bonds. So I really liked it. And so I was 17 or 18 when I was reading that book, and I was going to go to UW Madison for college. I already had enrolled there, or whatever it's called, agreed to go, was accepted. And so I started looking at duplexes just online, little rental properties, and thought, once I go there, I'm going to get a realtor, I'm going to buy a deal, and I'm going to move into it. I'll rent out one of the units, and then take one of the bedrooms in the other units, and just rent out the other bedrooms to my friends. And that's what I did. So I bought my first deal, when I was 19, as a freshman. And then, for the HGTV thing, that was, they came, that was something I didn't seek out. Like, I was not, pretty nervous to do anything like that. I'm not really like a promotional person, but they came to like the local brokerage offices, and they said, like, do you have any interesting clients? We're doing a show, doing different markets and showing what you get for the money in different cities. So I was the $250,000 house in Madison. It was an interesting show, because on that show, they also, I forgot the other cities, but one of them was Los Angeles. And you didn't get much in 2005,
It was like a
for a
down
quarter.
payment for
Yeah,
your
it
down
was.
payment in LA is $250,000.
Yeah, they found a studio somewhere, for a quarter million, in LA to highlight. But yeah, it wasn't much. And I had a 5-bedroom duplex, with a yard and parking to show off that had just been renovated.
Okay, so that
So
was 2005 when that was created, right? Because
exactly.
I,
Yep.
I, because I remember I, I remember hearing like in the video they talk about how the interest rate's locked for like three years, and then it's going to go up after that. I was like, oh yeah, okay, he got a 3-year lock, right, at a lower interest rate. Did that actually turn out for you? What happened with that investment?
Turned out great. I sold it in a year, and I bought it for 220, and I sold it for 270. I increased the income at the property a lot, and that's I didn't know it at the time. I was so new. Like, when I bought it, I was just focused on finding something at that was cash flow positive. So I spent a lot of time understanding the rents and expenses, and then understanding what was the prevailing gross rent multiplier in the market.
Mm-hmm.
So I was paying a fair price for it, for the rents that were there, and that was it. I didn't really want to overcomplicate it. I thought, okay, if I overpay, then I'll just hold it, and I'll cash flow, and I'll, eventually it'll go up, and it'll be fine. I won't kill it on this deal, but I'm also not going to lose money. But ended up, I did buy it at the right gross rent multiplier, and I was able to get more rent than I thought. And then the market continued to improve. And so, being a teenager, I was like, all right, I'll just take the profit and move on. But the thing too, I'd say, just on a shorter, a fixed rate term that's shorter, 3 or 5 years,
Mm-hmm.
I wouldn't personally, I wouldn't shy away from that. And I've done over 40 real estate deals now. And like you mentioned, bought like $250 million of property, that all those deals I sourced and raised the debt and equity on. Um, Really, what's more concerning from when you finance deals is the actual loan term, or when your maturity is. So if that
Mm-hmm.
was a 3-year loan, and also a had a maturity in year 3, so you have to either pay the property off or sell it or refinance, like, that's where people get into trouble. And like, the most famous example of that is General Growth Properties, one of the biggest retail REITs in owners in the world. They went bankrupt in 2009, because they had over half their debt coming due, I think, that year. So then there was no lenders, and so then they were out of business. But
Well,
that
Drew,
was,
do you expect some of that to be happening here shortly? With
I actually kind of, it depend, it really only in certain certain product types and certain parts of the country, because a lot of the deals, let's say multifamily around the country, the number one lender is Fannie and Freddie by a wide margin. They do more lending than any other lender by a factor of 2. Like, I think they're somewhere in the neighborhood of 50 to 70% of the financing market for multifamily. And they do primarily people are doing 5 or 10 year either floating rate or fixed rate loans. But if you do a floating rate, they force you to buy an interest rate cap. So everyone has a lot of loan term. And I think people got into trouble before in 2008 because you had a lot of people that didn't have a lot of loan term. They had floating rate loans, but the rates were a lot higher back then. I mean, I
Mhm.
remember borrowing in the 7s and 8s in some of these deals, and so
Mhm.
it's a little different picture if you're doing a 8% interest loan that comes due next year, and your business plan was to buy this apartment and turn it into condominiums, and then the condominium market evaporates. So there will be distress, but it's going to be, in my opinion, it's going to be really around office properties, and then I think industrial and retail is good. There's not going to be much distress there. Uh, Depending, I mean, some retail is just going to be more of the same. Where big box retail's not hasn't been a good place to be for over a decade now. But small shop retail is. We have a few of those properties still that I bought around 2010, and I mean, every year rents are higher, like in the market, and there's still a lot of
Mhm.
demand for those. In multifamily, the distress is going to come around those the markets where it's like every property sold in the last couple years, and people were doing those 3-year term bridge loans from
Mhm.
debt funds, where they were, and these were common in real estate syndications. It was the most common financing structure because it's non-recourse loan dollars that also you have construction funding. So if you were investing in a deal in wherever, primarily in the Sun Belt, where they're going to buy it, renovate it, and then sell it, like the odds are that was with a debt fund loan that was at a higher LTV, and then was only a 3-year term. So I think really it's more around the loan term, and then they're going to face, say you bought it in 2021, your loan's going to mature in 2024, and let's say you bought 70% LTV, was with the financing you put on when you bought it, then values dropped, plus or minus 20%, 30% in some areas. Your property might just be worth a debt if you didn't do anything to add value. And so now you got to do a cash in refi or sell it at a loss. So that,
Mhm.
but then I know it's a long answer, but then there's also been so few deals for sale where I know in New York, roughly, they're down about 70% in terms of transactions. Phoenix, it's in the 70s, which is Phoenix is a market we invest in.
Mhm.
So the odd thing that's happening is, let's say there was a deal where someone took it out in Phoenix to sell, and they're going to sell it at a loss. There were over 10 offers on it, and we bid on it and underwrote it, and that got priced to where on our numbers the buyer will make less than a 10% IRR, which if people aren't familiar with IRR, it's a time weighted version of annual return. So it's just like they're accepting a return on a deal you need to renovate that it's less than 10% a year according to our numbers. So the odd thing is, technically, yeah, I guess that's a distressed deal. The guy's loan's coming due. He's going to sell it at a loss, but that's literally one of the only deals that's selling right now. So then it got a ton of offers on it and action on it. So it's
Interesting.
interesting.
What internal rate of return are you looking for from the assets that you're purchasing?
Yeah, it depends on the risk profile, but I'd say 14 or 15% deal level IRR.
Mhm.
And that's not out there in today's market unless
Mhm.
you're really buying in a tough locations or very old property types. But generally, our business, yeah, today is we're buying multifamily properties that are 5, units if they're in, let's say, Chicago, on up to 100 some units if it's in Texas or Phoenix. And then we're buying it, we're renovating it, we're forcing the appreciation by making the rents and the net operating income higher. Um, and generally those kind of deals, if we've been targeting a 15, but we haven't bought anything in a year. So
Mhm.
it's the sellers are they don't need to sell yet for the most part. Even if you put that loan on in 2021 or 2022, you still got, if it was that 3-year loan I'm talking about, they still have more term. They're still holding out for rents to go up, rates to drop, something to change. But that's what we're solving to. And then historically, our average on our sold deals, we have a 25% IRR as our average return on a 5-year average hold. So just around um, just over a 2 equity multiple. So, but prior to this, we were doing a lot of buying existing deals that did not need renovation, but the rents were just below market. You know,
Mm.
I did in Chicago 15 full equity cash out refinances in a row, and on most of those deals, only one we did a gut rehab on. All the others were either doing real small stuff, buying a deal that was maybe built 10 years ago. It just feels a little older, has black appliances and not like a granite or quartz countertop, and doing, you know, simple stuff, getting rid of the carpet, putting in vinyl, repainting all the walls a nice light gray,
Mhm.
stainless appliances. So not a heavy rehab, you know, like it already had laundry and forced air heating and cooling and the right plumbing and electric. But yeah, in all those deals, we were able to, you know, raise the rents over 20%, really lift the NOI a lot, and then refinance out all of our equity without doing a ton of renovations. That's not really available in the market now because rents, the rent growth has plateaued. So everyone, even if your rents were below market, you kind of caught up to it the last couple of years, caught up to
Mhm.
market, and then interest rates are higher. So then uh, these loans are not only sized by a loan to value threshold, but also a debt service coverage requirement. So just to explain that kind of simply, basically, if your interest rate is higher, you can't borrow as much money, even if the value stay the same, because they're looking for a 20 or 25% cushion. You know, above the loan, the annual principal and interest payment, in terms of the net income from the property. So if a property made, let's say, $125,000 a year of net operating income, the lender is going to say, okay, I want to be at a 1.25 debt service coverage ratio, which means I'm only going to size a loan where the loan payment will be $100,000 a year on
Mhm.
that example.
Mhm.
So then if your interest rate goes up, obviously you can't borrow as much if you can only pay $100,000 max on the mortgage. So so then that's also been an interesting, you know, thing too, where now not prices fell, so that's great potentially as a buyer, but the loan proceeds fell by so much, it's still hard to make these deals work.
That
So
begs the question. Um, I see that when I went on your website, you're sourcing a lot of deals offline, right?
yeah,
So let's talk a little bit about your process around that.
yeah, it's funny. It's going to be simpler than you think. Really, uh it's you the deals we buy, the size that we buy, almost every deal is has a broker attached to it.
Mhm.
It's myself and everybody that's, you know, owns larger multifamily deals, they know you get a higher price with a broker. I mean, just think if you were going to offer on something and there's only one of it, and if you know no one else is looking at it, like how are you going to approach that offer?
Mhm.
Or if there's only one and 10 people are bidding on it simultaneously, what are you going to do? You're going to be faster. You're going to offer more. Like you push yourself more.
Sure, it's the auction
So
effect.
yeah, so most every deal has a broker attached to it. But what we've done is we have uh, developed close relationships with the brokers in our markets over time, and and then getting deals off market from them where they know what kind of stuff we buy. So then and we're talking to them regularly. So then if it comes up like, hey, this is just like the deal you bought before, they'll send it to us ahead of time. So then that's how we bought most all of our deals. I think
Mhm.
across the 40 or so properties we bought, only two have been one of those scenarios where it's a best and final sort of auction scenario where it's like, hey, all the offers are due on this certain date. Then we're going to go back around to the highest couple offers and then see if they'll up it again. And the ones we did buy, there was it was heavy value add available, and so it was kind of, I think we had a good business plan compared to the other folks probably bidding on it, and that's why we got it. But yeah, most all of the deals have been more just direct off market through a broker. And then the reason we're getting those deals, when you're like, what's the system? There's not, the system is actually just be a solid buyer. So a
Mhm.
lot of people, and I didn't realize this, but I've been selling in Chicago. I sold 3 deals in 2021, and then one this year, one last year. Got a couple on the market now, and on every deal, they're retrading you on price over all this little stuff. Things that when I go to a property, I already notice and have in my numbers. Where I'm walking up to the building, I'm looking at the exterior, I'm looking at the windows, I'm looking at the water heater, the furnace. When we're touring the property, if we can go on the roof, I'd like to, and I look at the parking lot. So I'm trying to really take in what's going on, so then there's less surprises. And at this point, if a property has a pool, I just assume it's broken, and it's just,
Mhm.
I joke, if you see a pool, put 50,000 in the spreadsheet, and we do that until we see it's not broken at this point.
Mhm.
Where I think so far it's like somewhere in the neighborhood of 80% of the pools we've acquired have needed to be rebuilt. So like I don't go there assuming the pool is perfect and then asking for money. I'm doing it in the opposite order, and then that makes you a really reliable buyer where I'm not asking
Mhm.
for little ticky tack stuff. Um, on one deal I'm selling now, I'm being asked to like paint a little piece of metal, um, and other little stuff where it's like, okay, that's fine, but it's like they're not making it a great experience on
It
the sales
creates
side.
so much friction, right? There's so much friction in that process. Yeah.
So if you're gonna buy, obviously you can't be a pushover if the you told the roof is new and it's 30 years old, needs to be replaced. Yeah, ask for a credit. I mean, honestly, they lied to you. Like it that's makes all the sense in the world. But on this, the I a lot of times you want to think the relationship is bigger than the deal.
Mhm.
You have different partners on different deals, or at least I do, or investors. So you can't just be 100% only relationship and getting, just plowing through problems, completely ignoring them. But you need to find a balance, and then that's how you get the deals in the future and get a reputation as a closer. So
Mhm.
that's what we've developed, where we got a reputation as closers who aren't retrading over ticky tack stuff. We're really communicative, where we tell the brokers what we want, and then if they send us something that doesn't fit the box, we tell them what we do and don't like about it, so they can refine what they're sending us, which a lot of people don't do. They just don't even call the broker back. My phone's ringing all day. I'm getting emails all the time, deals for sale. But if it's kind of in your what similar to what you're looking at, you need to give those brokers feedback so they know what you want, and then they like the feedback. They like to, they're calling you. They want to hear back. So it's really more, doing those sort of things of what's been able to get us the deals. Because then, I mean, I hear brokers talk where it's like someone says, "I want this building like this," then they send it to them and they don't buy it. Like
Yeah.
if you send me a deal that's like that's what I want, I'll always buy it.
Drew,
So
well,
I
let's
mean,
let's let's talk a little bit about that. I want to understand your business thesis, right? Your buy box. What is it? What is it that you guys are looking for? What areas? Why? What's the overall thesis of what it is that you're building?
so at the start of my career, so yeah, I ended up in Madison. I bought the 4 multifamily deals on my own, and then I moved to Minnesota. Got my first partner there, and we bought all commercial properties for the first 3 or 4 years, and then started buying multifamily again. And we were generalists, I'd say. We specialized in the Minneapolis St. Paul market where we were living, and then also Chicago. But really, we're doing all product types in those markets. So we were experts, but not experts in one sector. It was really more just being an expert in the city. And what I found is, real estate is very competitive. It's multifaceted. You have legal, you have finance, all these different things. The actual physical building you need to know about. And so what I've noticed, people that do the best is they're highly specialized. So we've now specialized in only multifamily, and only multifamily in certain markets and certain types of multifamily. So we're only buying multifamily in Phoenix, Dallas, Austin, and potentially some still in Chicago that is built since 1980, so more recent than 1980, and that has to do with the plumbing and electrical systems, really more than anything. And then it has is a $5 to $30 million deal in certain areas of those markets. So we won't just buy anywhere, and we have a location scoring system that pulls in incomes and growth by zip code, that then we kind of can make a map of each market and where you'd want to buy, and then obviously go to the market and make sure that sort of lines up. And then and then that's a value add deal, because when people throw around this term value add, but really all that is that if, let's say, you buy a deal there's nothing to do to it, it's a finished property, and you pay the sort of appropriate cap rate or gross rent multiplier for it, from there you're just going to get the return of the market, not any better. So you have no sort of advantage or additional return. And in some of these markets I bought in the Twin Cities and in Chicago, the market hasn't really done much. I think Chicago apartment prices have been pretty flat, 2015 to 2023. But on our deals, we're doing cash out refinances full amount. We're generating 20 plus IRRs. It's because we're creating the value. So then I want deals that meet all that criteria I said, but also then have room to either renovate it or just move the rents to market rates that are much higher. So like that deal I was talking about that we bid on that got priced to a 10 IRR, that was a deal in Tempe, Arizona that would was built in the 1980s that would require a renovation, not a gut rehab, but just adding laundry, redoing the kitchens and bathrooms, new vinyl flooring, and paint and be out. And so that was a like those are the opportunities we want to do. And multifamily was uh, sort of like it's something I thought a lot about and what to specialize in, because the commercial deals we did have gone really well, but there's a lot of volatility with commercial property where if all the deals we have between 2 to 6 tenants. So you lose a tenant, and if you only have two tenants, now your property is losing money.
Mhm. Mhm.
And where with apartments, if you got 8 unit, you got 8 different units paying, or it's a 20 unit, and you lose a tenant, it's not hard to refill it, and you still got the other, if it's 20 unit, 19 ones uh, full. And so I look back to, and we calculated the data where there's this index. It's called NACREIF. It's a real estate trade group, National Council of Real Estate Investment Fiduciaries, but they have data that's supposed to kind of show like what private real estate's done, and they have that by property type. So we looked at the data, and from 1990 to 2020, multifamily, it had the highest returns for all product types. So compared to industrial or office or retail, for all hold scenarios. So you could have held the property for 3 years, 5, 7, 10, every scenario over that 30-year period. Multifamily was literally the highest for every single one of them, and had the lowest volatility of returns for every scenario, except there was, I think, one where either retail or industrial had lower volatility, but then also lower returns.
Hmm.
And so, yeah, I like that it's easy to re-rent, had the highest returns, lowest volatility. I like how the income was diversified across a bunch of different tenants working at different places. I mean, even during COVID, we collected 99% of our apartment rent, and weren't really having any issues. But I spent like all my time talking to the commercial tenants because they all needed some deal or were closed,
Mhm.
um, and then obviously like current renters are renting longer. Homes are not getting any cheaper, to build. At least, we'll see what happens with interest rates and how much prices move, but it's hard to buy a home. Back in the old days, you hear your parents or whoever bought a house for 10 grand, and it's not not like that anymore. And so you have a big pool of people renting and renting for longer, and I really like the lease term being 1 year. It's like the perfect amount of time. Hotels, you got to re-rent it every day.
Mhm.
And then these commercial leases that are 5 or 10 years, I mean, that sounds good, but then if inflation starts running and you're capped at 2 or 3% per year increases,
Mhm.
that's not
Mhm.
ideal. And then the debt landscape, one thing right now when you're talking about where's the distress, um and there'd be some in multifamily, but it'll be all the people who did the debt fund loans. There won't be any if you use the agencies. So one
Mhm.
thing that really is great for multifamily is they have access to the Freddie and Fannie loans. So today there's still multifamily deals selling, even though the banks have really pulled back, but and the debt funds have as well. But Fannie and Freddie are just lending sort of business as usual. So on any multifamily deal, you can go get a 5 or 10 year fixed rate loan around 6%. If it's 5 units or more from Fannie or Freddie, where if you're in retail or office or these other product types, most of the banks, they're pencils down. They're not getting loan payoffs, and so they don't have new money to put out, and they're worried about losing deposits and being in trouble. So they've really pulled back, and so that's a huge advantage multifamily has at times like this.
What do you think is the lowest hanging fruit for value add when it comes to looking at a multifamily property? Right? When you're going in, I know every property is different, every situation, but you've probably found there's some really simple things to do to add value when you're just approaching one of
Yeah,
the
I think the
assets.
answer might even be simpler than what you're thinking about. A lot of our best deals, there's been no construction involved. I think you're saying like the best return is, switching the light fixtures or something. The best returns actually probably find a deal that got rented out uh, outside of the peak leasing season. So let's
Mm,
say in Chicago, nobody wants to the rental market. You get way higher rents. I'd say 5 to 20% higher if you rent your unit between April 1st and September 1st,
mm,
compared to if you're renting in November, December, January, February. Yeah, that's just all has to do with holidays and weather. And Chicago gets a lot of people graduating from all those Big Ten schools and moving every May. So yeah, I mean, in my opinion, peak rents are in May. So some of the best deals I've done have been buying a brand new building that they leased out in December,
mhm.
buying it, and then working out deals with all the tenants to end the leases in the prime season, and then over time getting the rents to true market, being able to rent them in the right season. And it depends in every city. That's Chicago. And like in Phoenix, for example, it's a little different where they have a drop off around the Thanksgiving and Christmas time, and then their slow season actually is starting right about now. Once it's triple digits for the next 3 4 months. Nobody wants to move when it's 115 out. So like it's so there then if you see a deal that they leased it all up in July or December, same thing. Try to get that all in the late winter, spring, fall, and I'd say that's actually the best play. You don't need to worry about changing light fixtures or doing anything.
Interesting.
But if it is physical though, I would say it's actually the paint colors. You could
Mm,
do a lot just painting it a nice light gray versus just like a color that's way too dark, making it seem smaller or just darker, or the builder white. That building, the ones we'd usually buy from the builder, it's like yeah, they just painted the walls white with the flat paint, same thing as like a ceiling paint almost, and so that's something we would always do too. Come in with
okay.
we got our grays all picked out already.
How do you feel about putting in laundries into facilities that don't have them? The
Yeah,
builders.
well, we're doing that. A few of the deals we bought, they've had a on-site laundry room, and then we're adding in-unit laundry. That's a really nice value add, but that's a lot more work so that's why that wasn't my first one. But yeah,
Got it.
every property I own has laundry in the units, or we bought it and are actively adding it to the units right now.
Interesting. Okay. Okay. So what I got was just talking to the brokers, right? The brokers control all the inventory out there. They should. And then being a good buyer as being somebody that's just going to buy what you said you're going to buy. If somebody brings you a deal, hey, like you're going to move on that one, right? Being a good buyer. And it sounds like there are very particular markets that you've been focused on. Are there any markets that you've got your eye on moving forward over the next 5 to 10 years? Right. So right now you're in Phoenix, right? Are you in Austin? Did you say you're in Austin as
Well,
well?
I live in Austin, and I'd say
Okay.
to just pick up on it, we're moving the business, if you will, to the markets we want to be in for the next 5 or 10 years.
Yeah.
So multifamily, especially, it's kind of simple where you you want to be buying where the people are going,
Mm-hmm.
and
Hmm.
the populations are growing in all these business friendly states with the good weather. It's actually not more complicated than that. It's already the places you already know: Arizona, Texas, Florida, around Atlanta, the Carolinas, Nashville. Like that's where everybody's going, and and so and a lot of times too, what's interesting is the knock on those markets is there's a lot of supply. But right now, a lot of the proposed projects are not getting started. They're not be able to get equity because the investors are because the returns dropped because prices dropped and interest rates went up. So
Hmm.
now they're not able to raise the equity, and also their construction lenders, these banks are saying, you know what, we don't want to make this loan now. Let's wait a year. So a
Hmm.
lot of these proposed projects are not going to happen, and I was in Phoenix earlier this week, and they're talking to the brokers, and everyone was saying the same thing, where it's this stuff's either not going to get built, or if it does, it's all going to be built by 2025, and then there's going to be this huge gap where there's nothing going to be delivered because no one's starting new projects now, and this is going to be like this for a couple years where nothing new is going to start. So that's always been the knock on those markets, but a lot of that stuff's not going to get built. And then also too, we don't buy the brand new shiny class A stuff anyways, and that's really obviously if you're building new, like everyone just builds the nicest thing possible because you've got to buy a countertop anyways. You may as well buy a quartz one compared to a
Mhm.
laminate if you're just going starting from scratch. So then that's the other thing is like these all the new supplies at that highest price point, and a lot of times the deals we're buying, they're like $1,000 a month cheaper than those. So it's not like more of that stuff gets built and people leave our buildings and say, oh, it's fine, I'll just pay 50% more in rent. Like they're not. They're looking to go from a place that was, if they're going to trade up, it'll be from a $1,200 rental with no laundry to like one of ours with laundry in the unit for
Mhm.
1,500 or something.
Mhm.
So
Mhm.
so
Interesting.
Phoenix, Dallas, Austin is where we want to play. Phoenix, I really, that's my favorite market, where that has it's a high growth market. I think historically, rents have grown from 2013 to 2019. So it's a time period I like to talk about because you have no COVID bump, and because obviously they went up a ton since then. But rents grew 7.3% a year in Phoenix from 2013 to 2019. From 2005 to 2019, they grew 4% a year. So it's a high growth market, and it has the best property tax arrangement in the entire country. There is a 5% per year assessed value cap on the property. So, like, arguably, California has the best, system where there you have no increase. They just market to what you paid and leave it there. But uh, in Phoenix, if you sell it, they don't change it. So we have so you really you raise the rents, you push up your NOI, and then the next buyer takes full advantage of that as well. Where in all these other markets, maybe you do that, but then they move the assessed value to the sale price, and it doesn't really help you on the exit. So you
Mhm.
can create. That's why Phoenix often has been, in the last 10 years, has been one of the highest appreciating markets in the country. And this is a relatively new setup for them. I think it's called Rule A, and it passed in like 2015 or 16. So it hasn't always been like that. So this 5% assessed value cap. So and then Texas, or at least we'll say Dallas and Austin specifically, we have a market model that we've one of the guys who works for me, his hobby is sports analytics, and
Mm.
we pulled in all the variables you'd want to that are important. So population growth, apartment fundamentals, single family, uh, housing data, job data, job growth, everything you'd want, and then you figured out what's correlated and back tested it. And the number one thing correlated with multifamily appreciation is job growth as a percentage. And Austin, Texas, has been the number one job growth market as a percentage uh, for a very long time, and by a big factor. It was like two standard deviations above the national average. Uh, Raleigh was like the next biggest job growth as percentage market, but not even close to Austin. So Austin
Interesting.
has been number one as percentage growth for any of these like larger cities for population and jobs. I know Boise, Idaho was up there, but that's a small market, and then just seemed kind of bubbly for our liking. But anyways, that
That
and then Dallas, yeah, or jump in, Rob.
Yeah, I was going to say that brings me to a question. What is your team? Because it sounds like that's cool. You guys didn't go to an outside source to get that data. You actually pulled it in house. What does your team look like today?
So we have me, and then two acquisitions guys, and then one of them was one who made the model. So the three of us, we work with the brokers, we get the deals. We also do call owners off market and have relationships with owners directly. But I've maybe bought two or three deals that way, and then the other, whatever 40 were from through brokers. So and then we have a couple accounting people, and then one asset manager who only works on the deals post after closing.
Got it.
So
And it sounds like it takes time in between getting some of these deals, right? Like you haven't bought a deal in the last like year, you said,
correct.
right? Is that Is that been unusual for you guys? Were you guys just doing a lot more deals the last few years, and then in the last year it's been more difficult? And I guess what I'm arriving at is how are you creating what I would call your active income in the business? Obviously, you've got this portfolio, and you're paying yourself now from this portfolio, and you're obviously paying your investors as well from that portfolio. But is there anything that you guys are doing also to create more active income within the business?
Really, really, we're not. You know, these deals are all about what they make. So I'm doing this. I'm raising money. I'm doing the deals because I invest in them, but also, you know, I get an incentive fee if the deal makes over 8% IRR. Then I start getting to share the profits, and then if it goes above 12, I get a larger share from there. So I'm doing it just for what the deals make. And so yeah, at a time like this, the last 12 months, or yeah, our operating companies lost money, you know, where but the properties have made money. So I still have money coming in from the properties where I'm an owner at different percentages in
Mhm.
$200 million of property. So don't, you know, cry for me that the operating company lost money. But you know, we charge, you know, some fees, but those are you know, for the operating company to make money, we need to be acquiring properties. But
Mhm.
I don't push deals just for that reason alone.
Sure.
Like I'm fine with how it's going. And yeah, normally I was buying 1 to 5 deals a year, I'd say, was kind
Mhm.
of the cadence. That would be probably our average was 3 since 2009, probably 3 deals a year, I'd say. And yeah, we'd spend all year looking at deals, looking at 1,000 deals to buy three. You know, probably
Mhm.
the math on that. And so we're still doing the same thing. The only trouble is now you look at it and the one we liked, it doesn't make enough, then you pass on it. You know, we still bid on it, but then we got outbid. So it's just been a year of getting, you know, outbid on things and, you know, chase the opportunities that come up. So it would be obviously better to be generating more active income, but I don't want to fee these deals to death either. You know, we charge an
Sure.
acquisition fee and then an asset management fee on some of the deals, not all of them. Depends on what the incentive fee arrangement was, and that's about it. So there's not a lot of fees, but I'm getting distributions from every deal. You know,
Mhm.
unless it's under renovation, then there's no cash flow while we're renovating. But
Mhm.
you know, so it's really more about property ownership and just getting exposure to the upside for me.
Got it. How do you guys work with your investors? What does that look like?
So some of the deals that we've done, or most of them, was a one investor in each deal. So the first 2009 to 2019, I actually just had one investor, and we
Mm.
bought $100 million of property together. He invested less than 10 million, but we just through doing the refinances and doing good deals and selling some, then doing 1031 exchanges into bigger deals, we built that portfolio up. And then 2019 to 2021, same thing with another investor, bought about $100 million of property. And just sort of recently, in the last couple of years, I started syndicating deals. So
Mm.
then taking on, because I'd have people come up to me, or not come up to me, that I knew, and say I'd want to, you know, I want to invest 50,000 or 100,000. Like how could we do that? And I actually would say I can't. I'm really just set up. Got this one person or two. You know, I call them. They throw in $2 million. It's, you know, it's a setup for that. I know how much they want to invest, what we're looking for. It's it's
Sure,
nice, but
you don't have to herd cats. You've got one central person, but there's also sometimes risk associated with having just one.
yeah, exactly.
Yeah.
And so and so I wanted to, you know, expand the business, and then also too, like, offer something to those folks. Like some of them, it's like my brother-in-law and like people like that. Um, Other people who bought properties in Chicago, they saw we were doing deals well, and were like, "Can we just invest? We don't. This is a lot of work doing the deals."
Mhm. Mhm.
And so yeah, so we have a list of investors, and you know, if anybody wanted to join it, you just go to our website, breneman.com, and click invest now and sign up. And then when we have a deal uh, to invest in, we send it out to our list, and it's just first come first serve. And you have to be an accredited investor. And we, since I talk about it on podcasts and whatnot, you need to verify also they're accredited. So then we just do that with like a third party website. It's easy for them to do. But um, so yeah, then folks invest in the deals. They get you know, they're members of the LLC we use to buy the property, and so that gives them direct property ownership. So they get cash flow, and also, you know, all the depreciation and all these tax breaks people talk about. You know, that's all taken at the LLC level, and you're a member of it. So then you get your share of that. So a lot of these deals, they don't throw off any taxable income while we own them, and then they're distributing cash. So
Hmm.
It's really a tax advantaged investment where you have cash flow and it's appreciation and returns are high. The downside is it's not liquid. So if you
Hmm.
need your money out, there's not a mechanism to do that. We use the investment dollars to buy the property, and then that money can't be returned till we sell. So,
How
I mean,
long is it? Are you finding on average 5 years, 10 years, or is it like, guys, we're gonna hold this for 20 years? What's kind of the.
it yeah, it depends on some of the deals where it's just one investor. I mean, we have had some deals we've owned for 13 years with no plans of selling them
Hmm. Hmm.
at this point. And then on the deals we've sold, the average hold period was 5 years, and on the new deals where we're syndicating, the average the business plan we're promoting is a 5 year hold. So I think is money real estate's more about making money slowly. So I would like personally, I would I'd like to be raising money in like 10 or 20 year periods and just say what we're going to do one deal, do the value add, then we're going to sell it, then we're going to do a 1031 into another deal. We're going to do that and then do that again and do like three of them because we've done that just with the one check investors and we've turned 1 million into two, then two into four, and then four into eight. Like that's how we bought 100 million of property with less than
Hmm.
$10 million in. um, so I'd like to try to do that in like a syndication style thing. So that's something
Hmm.
we're working on now where it's almost would be like a mini fund of sorts. It's like you like this deal, then you invest, but then the business plan is instead of just returning the money in 3 or 5 years, we're going to just do a
Keep rolling
1031,
it.
so no tax.
Hmm.
It's same thing. If we can't find that same kind of deal, then we're done. We'll return the money, but we'll find it and we'll be on to the next one. So that's something I'd like to start doing.
I love that. What's your trigger to determine, yes, we're gonna sell it now? Like, at what point do you determine, okay, we're gonna sell it?
Well, with the ones we have sold where there wasn't a defined business plan, it was just when we felt it was really topped out.
Hmm.
So where your rents feel like they're above market, or you're worried your property taxes are going to get raised on this one in particular, because you saw that on a similar building happen. That's really been when we've sold. It's where rents are above market, or we're getting some sort of uh, we think like we're getting overpaid on the
Hmm.
property. I'd
Hmm.
say really that, and then a couple we've sold have just been because they've been small. Like the deal I sold earlier this year was a $1.5 million 5 unit. It was the first deal I ever did a syndication on, and I just had two investors in it. And so it was good to try out and do it, and we doubled the money on a 5 year hold, but it wasn't. Um, it's not that exciting anymore at this point for me to have $1.5 million property,
Hmm.
with
Hmm.
partners. So we're
Hmm.
so like that also, I guess we sold that too because it was smaller and older.
Hmm.
Maybe that one wasn't topped out. That was so, yeah. And then I mean, we'd also be selling too in the future because let's say we raised money on a 5 year business plan and it's year five, and we told people we would sell in year five. So
Got it.
we don't have to sell. I mean, like legally, it's up to us on the sell timing. We could sell early, we could sell a little later, but like a lot of these deals we bought in the last 2 or 3 years, we put 5 year fixed rate loans on them, 3.5% interest. We're gonna hold them to loan maturity, and odds are we'll just sell them at that point.
What do you have you done any research on Knoxville, Tennessee? Just curious.
Well, I know Nashville is one of our top markets when we did that analysis. Near
Hmm.
term, it's going to struggle with that's literally the market with the most new supply. Nashville is going to struggle digesting that, for a year or two. But um, just being in Tennessee, like I know it'll be strong. It wasn't the model we made was for the 53 biggest markets, and Knoxville I don't think is in the 53 biggest markets, so that
Hmm.
wasn't in our model, but I know it's a good one. So if you're doing something there, um, I'd be all for it. These states with no state income tax are just booming with business relocations. And
Hmm.
Arizona has a state income tax, but it's very low, and their property taxes are peanuts. So you get you're getting a similar effect there, and all the people from California moving out. But yeah, these Texas and Florida and Tennessee and all the other ones with no state income tax, they're just really benefiting. So I would, I think Knoxville is great.
Yeah. Yeah, yeah. We started a team, a business in Knoxville, and I'm excited about it. I see a lot of opportunity there. I see a lot of growth there, and um, And I know Nashville's been hot for some time, so I was like, okay, well, let's look at Knoxville, a little bit smaller, but still going to benefit from that for sure.
For sure. What size deals are you guys buying there?
We run, that's our brokerage team. So we run a
Oh, nice.
brokerage team and we work with investors to help them buy assets that are there. So we've got a guy right now that just bought 20, right, and 20 units. And
Nice.
so we just want to continue doing more of those. And what I'm telling them is they should also be identifying some of those to buy and hold for themselves, or for us, for people within the network.
For sure.
So if we run across anything interesting, Drew, we'll call you. We'll let you know.
Yeah. Yeah. Sounds good. Anything 5 million plus, let's do it.
Okay.
We'll take a look at least. So,
Okay. Well, a couple things. I'd love to turn this more on a personal note, if that's okay with you, right?
yeah.
What are you building? Like when you think about, you know, you're doing all this stuff. You're young, probably thinking about the future, right? What are you doing? What are you building?
Yeah. It's an interesting question. And, cause I've already have enough money and, I still work a lot. And I think what I am doing is I want to challenge myself. I got off to this early start, and then I picked up a large investor early, and we did great together, and still are doing deals together. But I don't want to then be like, okay, then I was 35, I'm 37 now, and just be like, no, I just was chilling for the next 60 years. Like I don't want to. One thing I believe in, like with the way medical advancements are going, by the time I'm like 100, I think that might be pretty normal for people to be
Mm-hmm.
living a lot longer.
Mm-hmm.
Just thinking about my grandparents, they've had stuff happen to them where probably if it was like 50 years ago, they would have not survived it. And then it's just, like this with the way healthcare is going. So I think, I just didn't want to be like, oh, I took my foot off the gas, like, so early, and then you're 50 and you're like, yeah. So it's a weird motivation to say that's almost like a don't regret things or don't, but that's been a motivation for sure. And then two, a lot of the business so far has been, uh, pretty much every deal we found. I say we, but then I am interchanging I because I found the deals where I was
Mm-hmm.
always I didn't have any employees other than for accounting and property management till 2019.
Hmm.
So I found every deal. I did it. I was the one to saying, hey, let's move this lease expiration to May to do these things I'm talking about. Um, so I'd like to build a company that's a real company. That's what I'm working on now, where we
Mm-hmm.
have these acquisition guys. I mean, I want to get them to the point where they already talk to the brokers and underwrite the deals, but can really also see what I'm seeing and then turn this to a real business where it's not just me making most of the decisions and have not only leverage from like debt, let's say, but also operating leverage from other people and build a real company. So
Mm-hmm.
that's actually what I'm more focused on than I know a lot of people in real estate that they talk about legacy or passing things on down to their kids and whatnot. And I have a 5-year-old son, and so I think about that stuff, but I also think like, how do I don't even know if he's going to like real estate. It's not, it's weird to think like, yeah, I'll just take it over and be running this portfolio and be, me 2.0. Maybe he wants to do like art or something. And it's just because I do see that from people we buy from. Cause it's like
Oh
the
yeah.
dad was building a nice portfolio. Then he passed away and his kids just start dumping the properties and they don't care. So I'm not thinking too much about like legacy or all this, or people will say you're a real estate mogul or titan or all these things to me that are just kind of funny. I'm
Mm-hmm.
just still surprised how things have gone. I was surprised that I bought $2 million of property, to be honest, when I was in college, and that I have 200 million now is kind of crazy, and it would be easy. Like with how we have it set up, we'll have $1 billion portfolio at some point, and it's just kind of surreal, and so I just want to keep going with that journey and see where I can get it to.
Yeah, and like you said, just building a business, right? That's sustainable. By the way, it's my daughter's 21. She's an artist, right?
Yeah.
She has no
See?
interest in real estate. Um, but and it's one of those things where for me, it's about building a business that operates, uh, that I'm able to pour into my people who want to build something, right, long term. Um, so it's cool. It's cool to hear you say that, right? Because I get that. Is there an investor or is there a business that you look to out there that you're like, you know what? I love what they're doing, right? Is there any North Star for you out there?
Yeah, I don't know if it's a North Star, but it's definitely watching Barry Sternlicht talk,
Hmm.
Starwood Capital.
Hmm.
Any video he's done and has been recorded and posted to YouTube, I've watched. Any interview, all these keynotes he's given, this little sit down fireside chats, I've seen them all. He's so smart, and I've learned so much. I have an undergrad degree in real estate, and I've probably learned as much as that just watching things on YouTube, and
Hmm.
not from the YouTube videos where someone's got like a whiteboard out and explaining how does this work. More just the insights these people at the top of the real estate industry, people like Barry Sternlicht, Sam Zell, of course, where he just passed away, but I mean, those two guys especially, and all the things you can find online, there's talks they've given. There's so many great insights in there.
So
So,
yeah, so I loved Sam's book. Am I being too subtle? If
yeah,
anybody hasn't read that book, but you know what? I didn't know that Sam passed away. When did he pass away? Like he must have
like
just passed
a
away.
month ago. Yeah, maybe not even. Yeah,
Unreal.
at the end. Yeah, at the end of May. So
You know, um, yeah, talk about a renegade for sure. And man, very similar story to your story when I kind of draw it, right? Like
yeah,
very
people
similar.
say that, but he actually was way ahead of me. Where he had a apartment business out of Michigan when he was in college too. But then when he asked what was it, he was managing literally like 1,000 apartments with his management company and bought like dozens of deals. And I bought two duplexes and two 3 units. So I was going, but I didn't have like the second biggest management company in Madison like he did up in Ann Arbor. So, but
Yeah.
yeah, he got started young and just kept going. And yeah, I knew a couple of guys who worked for him because he was lived in Chicago for so long, and he was really big on education. And the guys who worked for him just learned so much. So
Yeah, it's interesting because he said something like we always felt cash poor, right? Because they were just constantly plowing money into new projects, and so he
yeah,
was always. But what I like about Sam is that he took the discipline and he went into other businesses that were you know outside of real estate, but he just saw it. You know, he saw it.
yeah, yeah, he got it. It's interesting hearing those early stories too, where he like one of the first real estate deals he did. It was a hotel in Reno, and there were no like hotel brokers. I guess it was like he just heard about it from a person they wanted to sell, but they just offered like whatever they wanted. It's like back in the
Wild
60s or
Wild West.
70s, whenever that was. Yeah, that was the time to buy. Where it's I don't know, let's offer a 20 cap and to see what happens. And whereas very interesting. Where now real estate's definitely a lot more efficient,
Hmm.
so it's harder to generate those kind of returns compared to back then. Hearing those stories, so
Well, let's circle back to YouTube real fast. Obviously, you went to school specifically for real estate, but you know, my wife, who didn't go to college, she always says she went to YTU University, right? YouTube University. That's where she's learned just about everything, and she helped us early on. Like in a couple years, we had 300 properties under management, and my wife like did all that stuff, right?
nice.
Um, but I'm curious, like, what advice would you give somebody today, your younger self? Actually, let's ask that question. What advice would you give? You're already damn young. You're 37. You're young, right? What advice would you give to your 22-year-old self, right, at this point, knowing what you know?
Well, I maybe I'll answer it slightly different. These are the things that I did, but I didn't realize I was doing. Maybe
Mm. Yeah, yeah, I
because
love that.
I was gonna say something around
Unconsciously,
being.
unconsciously competent. So let's
I
talk about
was
that.
I was gonna say something about being curious and asking questions, but I'm like, but I did that. But one thing that I think that really set me apart, because I see this in other people that are doing real estate, where they're kind of acting like they already know how things work when they don't. You can kind of tell they're
Hmm.
responding that they're kind of uh, putting up a front almost of sorts, where they don't really know, and they're just kind of saying words and talking about it.
Hmm.
But so I never did that. I always, if I didn't know how something worked, I always would literally say that. I've
Hmm.
never seen that before. How does that work? And
Mhm.
someone I know,
Mhm.
he complimented me and he's like, "Where did you learn that line?" And I was like, "What line? The thing where I just said I how does it work?" He's like, "Yeah." And it never like crossed his mind to like, why would you ask someone like that? You look like you don't know. But yeah, but I want to know, and I don't think that's weird that I don't know it. So don't be afraid to ask questions, learn from questions, and then be curious about how things work. So
Mhm.
that's one thing where I've always, I'll have these phone calls with brokers or other owners or just other people, and I'm always taking notes. And I rarely reference them, but it's like I'm really learning a lot in these conversations.
Mhm.
Even and so I
Mhm.
think being curious, asking questions is like has been a huge thing for me. And then also my mindset. I always one thing that my dad said to me a lot, or said enough, was that you create your own reality.
Mhm.
And
Mhm.
I think that's really powerful where, a lot of these people, if you look at some of these like highly successful people in investing or real estate, or you look at like a Sam Zell or something. I mean, that for the most part, he's just a regular guy who liked wheeling and dealing. He was selling magazines as a kid and then doing apartment deals, but he just really went for it. He wasn't afraid to, take some big swings and, put all his money on the line. And like that was really, that's the difference where like these people where, maybe you're learning about investing in real estate, but you haven't done anything yet. Like that, the money's made in the action.
Mhm.
I think if a lot of these, I wonder what the percentage of people would be where they read the book by Gary Eldred that I read, and then they went out and bought a property. Because I
Mhm.
literally read that book and figured I this is all I need to know. I don't need to read another book about investing to get started. Like I understand how it works, and now I need to invest my money and learn like in the real world.
Mhm.
So sort of that would be my advice for young people. At the time I was just kind of acting how I acted, where I didn't have any pedigree or wasn't from a fancy school or anything. I went to all public schools for the most part. Like I didn't have any reason to have like a act like I was I knew everything, because I do see that, and that's like that'll really hold you back. Like just be humble, don't have an ego, ask the questions, learn. And um yeah, so like that would be all my sort of advice for the young folks out there.
I'm gonna double down on that a little bit. Um, I think if I'm being fully transparent, right, one of the one of the number one things that I noticed over the years of people that within our industry that like really accomplished unbelievable things within 5 years, right? Like it takes like 10 years to build something, right? Like 5 to 10 years to build something. And I saw the people that built things rapidly were really good at being okay asking questions, right? Like, I just don't understand. Tell me more about that. How does that work?
Yeah,
And they were always like picking my brain about how things worked, right? And the ones that picked my brain and then they went out and took action. Picked my brain and then went out and took action. And I remember then thinking, wow, I don't do that enough. Like I always felt like I
interesting.
needed I needed to get to a certain level before I earned the right to ask the question. I don't know where I got that from. And I remember
Hmm,
thinking, that's not good. Like if I want to go out and accomplish the things I want to accomplish, I need to be okay with just asking more questions, right? And always being the student. And people want to help, right? People want to help.
for sure.
People want to help. Um, so you only have one, Drew. You only have one 5-year old. No more
Oh,
kids.
correct. Yeah,
Uh,
I didn't. Yeah, and I only one. We'll see if we have more or not. What
okay.
happens? So,
Okay. Yeah, we only have one too. Um, what haven't I asked you that you think is important for people to understand about you, your business, what you're building, how to think about this?
well, I think, yeah, I think we touched on a lot of good stuff on my end. I think one thing to think about in knowing who your listeners are and what you do is, you know, a lot of this stuff with real estate, it almost sounds like it's too good to be true. Like the returns are high, the cash flow is high. Like there's tax breaks, but it really is like that. The downside is that it's not liquid. So that's in part why the returns are high, because all the people that need their money in a month or a year or even in 2 years, they can't invest in this stuff. So then if there's less investors in something, the returns have the opportunity to be higher because there's less people bidding on that thing. So obviously a lot of people do invest in real estate, but I mean, real estate is a really powerful tool. And if you're looking at trying to build for retirement, I mean, there's a lot of times I think of this when I was first starting out, I did, especially if you're kind of on the fence about real estate, imagine like you buy, let's make up some round numbers here, a $500,000 property. You put the down payment down. It's a rental property, so it's cash flow positive. The rents exceed the expenses. If you hold that property for 30 years, it's gonna, I would say conservatively, it'll double in value. It'll be worth $1 million, and you've paid your loan off. So you've just made $1 million. You still, I guess, would have your equity in it, but not including all the cash flow. Like it's such a powerful long-term tool for making money where that's almost your worst case scenario is it breaks even for 30 years, which has probably never happened on a property that's gone that it's always gone better than that. And then you pay it off and it's double. I mean, that's really something. And I don't know what the annual return is on that, but there's not a lot of things where at the end, it's okay. I put down, let's say it's a duplex for $500,000. I'm not, depends where you are on prices, but, you put, 100,000, 50,000 down, you're 20xing or 10xing your money, turning that into $1 million, not including any cash flow. I mean, there's not a lot of people that's how they've planned for their retirement. So it's interesting where if you're thinking about investing in real estate, I mean, it really is as good as it sounds. That there's work involved. And so if you can't do the work, then yeah, that's why people take on investors, because I see more good deals than I could buy all with my own money. So then I take on investors. So if you can do the work, I mean, I think the best way to do it is buy properties directly, kind of like what you're talking about, where you have a property in Knoxville you could buy and be the direct owner. But you need to manage the management company. You need to make a lot of decisions. You need to be reviewing things. And when expenses get, something's too expensive on a repair, you need to be the one complaining and fighting, if you will, with the management company. So if you don't want to be doing any of that, like then you should be a passive investor in someone else's deal. But I mean, I would just really, it is like how people say it is. And like that first book I read, and it's in part because of the illiquid nature, where like there are downsides where you can't get your money out if you need it. So
Drew, when looking at other multifamily owners that are out there, and you see where people kind of have gone wrong, because I think there's good operators and there's bad operators, right? What are some of the common things that you see that people just have messed up, right? Is there any?
yeah, a lot of things.
Mhm,
Yeah, I mean, the main things actually, I mean, three come to mind, and some of these are, it's sometimes very simple, but it's really important what you pay, and it's really hard to pass on deals. Like we haven't bought anything in a year. Like I told you, I'm adding money to pay for the employees and technology and software. Like it would have been great to buy that deal in Tempe,
mhm,
but I'm not doing anyone any help by buying a deal that makes 10% a year. I mean, that's not the outsized returns people are trying to get from real estate. So we pass on that deal. But then whoever, we see a lot of deals where they make less than 10% when we underwrite them, and they're selling all the time. And like, so those deals are sort of doomed from the start, if you will, because they paid too
mhm,
much. And
mhm,
it's hard. You get that there were 10 offers, then they do another round of bidding, and then you raise your bid, and you can get kind of up. I really want the property, and then they overpay. That, and then also people not matching up their loan with their business plan. In 2019 and 2020, uh, I bought, I think, 3 or 4 deals, and they were all loan assumptions
mhm,
where people put on loans in 2008 or 2005 when interest rates were in the fours with a yield maintenance prepay, which just basically to get out of it at the time, they had to pay would have had to pay 20% of the loan balance to pay it off. Because these commercial loans, it's not like a home mortgage where you can just pay it off with no fee. These are our prepayment fees to pay it off early. So because they selected that loan product, when their business plan, like these were all developers. They built the building, they rented it out, and they put a loan on it, and they put these ones with yield maintenance on it. And because that's the ones where you got the most proceeds that day, that's why
Mm-hmm.
they chose it. Because again, with the debt service coverage thing I was talking about, the rate was a little lower because it was yield maintenance. So that allows you to get more money and pay a little less interest now.
Mm-hmm.
But then when it's time to sell, they're jammed up by this loan. And then these deals were all acquired off market because they went to their broker and said, like, hey, I want to sell this, but someone needs to assume my loan. You got anybody? And these were all Freddie and Fannie loans. I've done at that point, I had done over 25 of them. All the brokers know that about me. And they said, okay, let's we'll send it to probably a couple guys. Was probably what they did. And I ended up that deal I just sold that I bought in 2018, loan assumption, 2019, 2020. Um, and those were great deals for us because we were bidding against basically nobody, saying, oh,
Mm-hmm.
you got this high interest rate in the fours, like we obviously can't pay as much as if we could put our own loan on it. We're putting more down than usual on some of these, and so we really wrote our own ticket on those.
Hmm.
And then it's also kind of comical in a way, then rates go up a few years later, and we literally were getting 10% plus discounts on these things because of the bad debt on them. That was so unattractive, being a 4% interest rate.
Yeah,
So
it's crazy, right? It's like perspective on all of it. Well, and I guess you said you just sold that. How long? What were the adjustments on those assumptions? Like when were those going to adjust, or were they going to adjust? Like
they're
you
not adjustable, they're fixed rate.
because they
And
were
so
because they were a Fannie and Freddie product,
yeah, correct.
right?
They
Okay,
they
got
all did they all did 10-year fixed yield maintenance loans.
it. Hmm.
One was a step down prepay.
Hmm.
So then it didn't have yield maintenance. It was just 5% the first 2 years, and 4%, then 3%, just kind of stepping down. And then we
Hmm.
sold it in probably year 8 of the loan, and we paid a 2% prepay to pay that one off at the end. But so yeah, that worked. So those have all worked out well for
Okay.
sure.
Well, Drew, I appreciate your time. Like that, this has been awesome. It's been an education. Um,
Yeah, thanks, Rob. It's been
I'm
great.
gonna I'm gonna go read "Investing in Real Estate" by Gary. What's his last name?
Eldred, like
Eldred.
Eldred, maybe.
You said it was an old book, right? But
They're still
old.
selling on Amazon. I buy it for people all the time. It's almost like a test I do. Like, here's the book, and then it's not expensive, $10. So I'll ask them, and I'll either buy it. Some people, depends on who they are, or I'll just tell them about it, and then I'll ask like if they read it or not.
Yeah, it's.
And so far, only I think one person in my entire life's read it.
Are you saying? Well,
So
I'm gonna read it. Like I'm gonna go. I'll actually. If it's on, is it on Audible? Probably not.
I'm
I'll
not
probably.
sure. I'm in the
Okay,
same boat as you. If it's just a physical book, I got too busy to read. But when I read it, I was just reading the book. I remember the
I'll read
green
it.
cover.
Like
Now they got a new edition where it's white. So
I'm a big reader, so I'll definitely make sure to read it. So Drew, if anybody wants to find you, to do their due diligence on you, to invest in you, where do they go? What do they do?
yeah, if you want to learn about our company, or get on our investor list, or just even our company newsletter, you can go to breneman.com. So B as in boy, RENEMAN.com. That's all there. We have a blog. We have the Invest Now thing, so you can sign up to be on our investor list. We also have a passive investing guidebook you can download, so that it's a 100-page PDF where we cover everything uh, possible about real estate investing and passive real estate investing. So what to look for when you're investing in other people's deals, how to vet sponsors, what's a waterfall, what are these fees. There's a glossary in the back about all these real estate terms that everyone uses so much jargon, and so that's all in there. And then I also have a podcast. It's called the Breneman Blueprint.
Mm,
And so that's on all podcast platforms and on YouTube. And so it's a real estate investing podcast. So it's less about, these are all for people that have already decided more or less they want to invest in real estate and learn about it. So it's a lot of active investors talking about what they're doing. And then I have some episodes for passive investors too. It's about a 50-50 mix. But a lot of the
mhm,
passive ones are just me solo talking about what to look for, what to do. And then lastly, I guess on social media, I think everywhere I'm at Drew Breneman, and I even just recently opened up a TikTok account, so I've been posting
Ooh.
clips. Yeah, clips on there. My sister works in social media for Kendra Scott, the jewelry company, and
Oh
she's like,
yeah.
TikTok, you gotta get on it. That's everyone's there, not just teenagers anymore. And so that's so we've been posting podcast clips there, and in Twitter is a really good real estate community of people on there. So I like
Mm,
to talk to people about what they're up to and talk about what we're seeing day to day on there as well. So
awesome, man. Well, I appreciate your time. It's been an
yeah, thanks.
education, and I'm glad we were able to meet.
Thanks.
Thanks,
Appreciate
man.
it.
Take care. Bye bye.